All right, some of you aren't moving, so y'all don't know what to do, or you just calculate it out. You've got the frequency and severity. You got the inflation for the expenses. Some of you already done it. Are y'all that fast? Staring at me hasn't helped anyone in their life ever. So take this as an opportunity to practice because the exam's going to be here in no time. All right, anybody got the answers? How much? On this one? Seems high. How much? 64? 64. You might have accidentally.
I multiply, yeah, I did 70 times 3 times 7 plus 71.
Yeah, you might have had your decimal off. 73 seems about right. Anybody else get 73? All right, what about the second one? Like 70? 72? All right, that seems about right. And then expenses? Point what? 72. All right. All right, so that's your first step. That one's straightforward. Just make sure you write it all out like this on the exam, because if you do have a math error, like if you actually put 1.02 but actually multiply by 0.2, I can probably tell that's what happened and won't hurt you. Right. Now, the way the question's written, this is really important to realize. If the n for the discounting is the same, and I made it the same for all of them, it's 0.5, it's 0.5, it's 0.5, it saves you quite a bit of time, because what you can do, if the n is the same, you can add all of step 1 and discount to the day. All right, so there's your step 2, and I'll probably do that in exam, because there's really no reason to make you do a bunch of extra work for no reason. Do you remember what discount rate you use? Did you need one? Anybody got one? What's your discount rate here? 5%. Yeah, you use the investment return as your discount rate. So your N is 0.5. So if you sum these three numbers, because they're all 0.5 in, you can get that step 2. Now, one thing to point out is add these three numbers together and get that sum by itself, because you're going to need that number. So don't do it in your calculator and then, Connor, you need one. You may know what that sum is. How much?
105.
Right here. All right, that looks about right. Uh-huh. Yeah, if, like, say the N was the same for these two, you could add them and then do it, and you have to do it separately there. That's what the example in the class was like. I think these were 0.75 and it was 0.5. But I'll try to make them the same on the exam so you don't have all that calculation. Anybody get that number? 0.7043. Wow, my hearing's really off. All right. Now my steps change after this, so I may not always do it in the same order. At step 3, let's get the investment return. So the investment return has 2 pieces to it, remember? We have earnings on beginning net worth plus the float earnings. I'm going to add a different step 3. So let's do something. Let's calculate required capital. Let's do that first because we're going to need it for step 4. So what is my required capital? Which ratio up here tells me my required capital? So you see it right there. It's going to equal 1/3 of premiums. Okay. So you need, remember, required capital, you have several calculations here. This is one thing maybe to get out of the way early. So you have the current year required capital. That's going to equal premiums divided by 3, which is going to equal 100 divided by 3. You have the next year required capital. There you have 2 premiums, so you have to test them both, right? Because the question gives you 2 options, 106.52 and 108.23. Yeah, if I were you, I'd get all these capital numbers out of the way because there are a bunch of them. Christopher. So you need the required capital on current year. That's what you're given. I gave you 2 question premiums in the problem. You got to calculate that. Let's look at all the other ones you're going to need. You're going to need the average required capital, which is going to equal the current year plus the next year divided by 2. So you have 2 options there. And I haven't calculated, but whatever, this number plus this number and this number plus this one. And then you have the change required capital equals next year minus current year. So you need all of those numbers. So it's 1, 2, 3, 4, 5, 6, 7 numbers. That's where most of your calcs got to happen. That'd be half of your calculations right there. Anybody got this one? And I think that one's 33.33, right? The average here. Numbers. All right, so we got all those numbers. So then the investment earnings, remember, your investment earnings are the same no matter what the premium is. So that doesn't bother you. We're not doing any investment earnings on that underwriting gain. So you got the beginning net worth. Times our investment rate, which is 5%, plus the float. The float is going to be the forecast minus the present value of the forecast. So in this case, our beginning net worth is 33.33 plus 5% plus. So our forecast was 105.98. And the present value of our forecast is 103.43. Right, so work through those, make sure you know where you're getting all the numbers from. Investment return is pretty important one because you're going to be essentially kind of stopped from getting anywhere if you can't remember the investment return. I'll just guess at a number. Is that close? You can do it in your head, so it's not. It was good. Got those numbers. All right. So after this, it gets a lot easier. Calculate net income. Net income is just your premium minus your forecast plus your investment earnings. That one's pretty easy. You'll have two numbers though, right? Premium 1 and premium 2, so you will get two different answers from that. Remember that your sum of those forecasts is the same number no matter what your premium is, so that will be the same. So you just got to figure out the two incomes. And remember your investment income is the same. Either one of those look right. 72. You sure? Check your math again. Because you got 4 plus 2, right? 5 with the 647. Right, right. All right, step 5. You do net income less change in required capital. This is just going to be your net income minus change in required capital. You have premium 1. 2, so we have our net income 4.76, 6.47. Yet our change in required capital is up here, 18.75. It's what? All right, it's 3. Oh, that's right, that's 4. Okay. Then only one last step to go. Make sure you have all these written down, not just the answers. Make sure you have the detailed steps. And then step 6, it's just calculate ROE. It's just going to be step 5 divided by average required capital. I disagree with those numbers. Do I confirm them? Yeah, okay. So which premium would you pick? So what's their target ROE? 7.5%. So it looks like the first premium. Why not the second premium? They make more money. Well, the state's not going to approve it. They're not going to be competitive. You know, all those things. They need to make their target. You don't have to write all that in. There's no essay component to this, so that's all you need. But that's the problem. I'll put this out there, but I say six steps. The one that's most of the calculation is step 3, all the required capitals. Just remember, you gotta have 7 numbers there. Be able to use those later. So might as well get them out of the way. I didn't write this one out, but it's down here. So this isn't part of the problem. Now you don't have to get every single thing right to get most of your credit. So it's not like you miss one thing and you lose all your points. You can get 85, 90% if you do most of the steps. Huh?
What it is exactly?
Well, you don't have to write step 1, step 2, but I would definitely, I would even write stuff like this. Just if I can see you know the formula, but you accidentally transpose a number, I won't count off anything. All right, so that helps you a lot. So the more you write down, the better. I don't need step 1, step 2, step 3, but you can definitely do that if you want to, if it makes it easier for you to remember. But don't write this down without anything else. Because if that's all I have, you know, if it's 105, 97, I'll probably say, okay, they got it. But write, you know, I would definitely write all of this. So if you accidentally multiply by 0.2 but you wrote it correctly, I probably won't count off for that. You just had to type, because on the exam, you know, it's nervousness and all that. So we'll hit a key wrong. So write down anything you can plug in your calculator, you might as well write it down first. You got plenty of time on the final because there's no essay in the final. You do that in advance. So you got plenty of time. So just write it all out. Be really, really careful. Because what's going to give you great confidence? If one of these 2 numbers matches, right? So you want to be cautious, not because you want partial credit. You want to be cautious so that when you get here, you're pretty confident you got the right answer. Because it's going to be pretty unlikely you're going to get this and have made a math error somewhere. All right, so be very diligent, take your time. And I'm hoping you step back and think what you're doing, because this really is what the actuaries are doing. So if you think about these steps, they're all in there. You got to forecast severity, frequency. You got to calculate the float impact by taking the present value of that based on the timing. You got capital requirements you got to meet. You got to get your investment earnings that comes after your underwriting earnings. I mean, it's all in there. Everything to calculate, all the calculations the actuaries are doing, it's all in there. It's tedious, but it's only one of 2. It's one of 2, well, 3 math problems. So, you know, it's not a heavy math problem. All right. No more questions on that? We'll put this out there. So let's do the Schedule P problems, which is actually my favorite ones. It's on the back because I didn't want to waste paper. So don't throw away that piece of paper. It's on the back. This we haven't done as much, so I'm gonna walk through this problem to we've done some of it, but we haven't really done it. So I'm gonna use this to teach you the problem, and then maybe I'll pull another exam question from a previous exam so you can get a little more practice. So there's 4 parts of this. Most students get all of this right. So this one's really pretty straightforward. The first question is really, really easy if you remember one little thing. So you can see here's their adjusted capital, and this is its authorized controlled level risk-based capital. So here's their risk-based capital. So here's the formula. It's really straightforward. RBC ratio equals adjusted capital divided by, and this is the real trick, this authorized controlled level is defined in the law as 50% of risk-based capital. And the law requires you to have twice that. It's a really bizarre law. We wrote them twice telling them, please change that. So you calculate risk-based capital, you take half of it. Half of it is called authorized controlled level, and you need to have twice that much capital. So why did they do that? It's really ridiculous. But the reason they said they did it is they didn't want anyone to get firms risk-based capital and publish it in the newspapers. So they thought if they divided by 2 and then multiply by 2, people would be so confused. It took the media like 13 seconds to figure it out. So it was complete waste. So you have to actually multiply this by 2. And that's their RBC ratio. You want this to be above 1 because the top is how much capital you have. And the bottom is times 2, authorized control times 2 is how much you need. This is different what we just did in the pricing example. In the pricing example, we used the premiums to surplus, the 3-to-1. This is a different type of capital requirement. It's an easier one. I mean, it's a more straightforward one. It makes more sense, but, right. So in this case, what year did they ask for? 2023. Their adjusted capital. In this one, I will let you get away with rounding. Their total capital, the adjusted capital, what that means is their net worth with a few minor adjustments. If you looked at their net worth, it'd be really, really close to this number. So 11,988,000,000 divided by their control level is 3,074 times 2. And that's going to give you their RBC requirement. And put it down as a percent. I get 195%. If you put it down as 1.95, I don't count all, but it's shown as a percent. Essentially, you're asking how much capital they have as percentage of the amount they're required. And you want it to be a pretty high number. In fact, 195 is not the greatest number of all. I've seen companies with it 500%, 600%. But if they hit 100%, the regulators will come in and start telling them how to run their business, and they'll be essentially taken over. So you want to be well above 100%. Right, that's a pretty, very, very simple question. Any questions on that one?
10%. Why did you move the decimal place 3 places?
What do you mean?
Maybe
Yeah, I got 1.95, so I just made it percent. Let me keep checking. If you can't get it, let me know. Anybody else get 195%? Okay. And it shouldn't be like 19,000% or 19%. It's going to be somewhere in the 100 to 300% range for most companies.
because I tried to put in all the digits in my calculator and
You ran out of digits. That's why rounding's fine, because it's so massive. Fortunately, down here, they round it to zeros here. It's not rounded. It's the full 11 billion. All right. This next one we haven't defined yet, but it's very, very simple. In fact, this is the one I think almost every student gets 100% on. The loss development ratio, the loss development ratios, and it's really not a ratio, it's just a dollar amount. It's really, really simple. What they're doing here, we're doing this as of for accident year 2018. All right, so you might want to bring a highlighter. I can't highlight in here because it's a PDF picture. When I say accident year, that's across. When I say for the calendar year, that's going down. So the accident year is 2018, so we're in row 6. All right, you're only doing row 6. So make a note. I'll try to remind you, bring a highlighter. You'll highlight row 6. In fact, I think on the last exam, I made extra copies of this because you highlight it for one question, now it's all messed up for the next question. So you can kind of have different versions you can use. So highlight row 6. And for the loss development, you only need these 3 numbers, the last 3 numbers. Because what the loss development, this is real similar. Warren Buffett used this. He talked about losses develop. They don't develop. It's just we messed up in the past and we know what they are now. But they call it loss development. What they're asking is, how bad were these last 2 estimates? So as of right now, as of 2023, so the calendar year 2023, we think the losses are 18,500, 150. But last year, we thought it was 18, 353, 364. And the previous year, we thought it was 18, 235, 859. The key for loss development is take the current year and subtract the prior year. So the 1 year development is going to equal current year minus last year, and the 2 year development equal current year minus 2 years ago. So in this case, 2018, 18,500, 150. You can use the same thing for both of them, 18,500, 150, and then you're going to subtract. Oh, year 18, 353, 364. And 2 years ago, you subtract 18, 235, 859. Yeah, everybody see where I'm getting those numbers from? So a positive number means they had to strengthen their reserves. It means they underestimated. They were too low. That's usually viewed negatively. It means they weren't conservative enough. A negative number is usually viewed positive view as a good thing. That means they were conservative. They had more. They set up more reserves in the past than they actually need now. I don't know what these numbers are. I can't do those in my head, I don't think. 18,500, 150 minus 18,353, 364. And 18,500, 150 minus 18,235, 859. I get 146, 786. Hopefully y'all double check me here. 264, 291. That sound right? Now, so that's pretty negative. With you look at Allstate, we're using Allstate. Typically, they're 1 and 2 year development. It's pretty close to 0, or it's positive and negative. They offset each other. 2018, I don't know if that was Hurricane Harvey or whatever. If there was a major event, sometimes they can be pretty far off for a few years, but that's pretty bad. And Allstate's usually not pretty bad. So their actuaries really messed up on that accident year. It doesn't mean they weren't good. It just means something unusual is going on and make it really tough. So generally you'll see it. I wish I could show you their Schedule P. Maybe we'll look at one. We'll practice a little more next Monday. So you can see Allstate's actual Schedule P. We might bring up the latest year here. You'll see if you look over time, it's when you sum up all of the years, we're only doing 1 year, but you can do that for every one of these years. You'll typically see more negatives than positives, and the sum of them all will be a slightly negative number. You don't want massive numbers either way because you want them to be accurate. But I know at USAA, when I used to work with Mary, USAA intentionally had a conservative extra amount they put in reserves, about 2 to 3%. So they intentionally over reserve. So you would, just because they add that extra cushion, you would expect over time that the loss development should be a negative number because the reserves decline as they actually pay claims. So even if they keep using a 3% cushion, it's on a smaller number because they know the actual number as they go. So we'll look at Allstate. We'll see how bad 2018 was versus other years. But that's a pretty bad year for them. And this is to help actuaries when you interview. You should know. I'm giving y'all some pretty good jargon. We talked reinstatement rates when Kirby was here. Here I'm giving you loss development. It's a strange term, just like Buffett said. It's really just your oops factor. All right, so the reserve, this one's fairly straightforward as well. I kept it with 2018, so you don't need a new highlighter for this one. So you're still going to use 2018 here. But for setting up the reserve, you can compare part 2 to part 3. So part 3, you also want to highlight 2018. But here I'm a little tricky. Ask what reserve would you set up, not for 2023, but for 2021? All right, so your calendar year is 2021. So we're sitting here in 2021. We're looking at the reserve for 2021. I mean, remember, part 2 is the amount they expect to pay out in total. It includes what they have paid out plus what they're reserving. So they expect to pay out 18. This is as of 2021. You don't know what's going on in 2023 yet. So what reserve did they set up in 2021? So 18, 235, 859. So part 3, how much have they actually paid as of 2021? Yeah, for some reason, my computer is frozen. Yeah, that's the problem, is yeah, all right. I'll have to fix this before I put it out there. So 2018, they paid 17,045,222. Pull the right number. Do y'all see that number? 2018 or 2021, 17,045,222. Everybody see that? So think about the numbers. It makes it pretty simple. The 18 billion is the amount they expect to pay out in total over the entire life of the product. They've paid out so far 17,045,2022. So the reserve, remember, the reserve is the amount they expect to pay out in the future. That's their float. They can still earn investment earnings until they pay it out. And so someone tell me that. Well, I guess I can calculate. How much? 637. All right, that sound right? Everybody? Okay. Obviously, reserves are going to be bigger for those products that are more recent versus the ones that are much further behind. I keep asking, I should have asked Kirby this question. I don't know if you would not. I keep asking my actuary majors to come back in a few years and explain this to me because I don't understand the first line. Never understood the first line. Doesn't make sense to me. It says prior, you notice there it's 0. You assume that's everything prior to 2013. But why is this number 0? But anyway, it's just a strange number. Maybe that's all it means is prior means, or we're just going to assume there's no, no payments, or that's the reserve, and they're going to come. I don't know. It's a strange line, but I'm not really sure exactly what the prior line means. But all the other lines, those are all accident years. That's why you have these X's here going across, and down here is not just the calendar year, but think of it as the calendar year and the accounting year. So part 2 is incurred, which means that's the amount they expect to pay over the entire life. Some of they have paid, some they haven't. And part 3 is what they have actually paid. But most students get that one. So those are the 3 easy questions. The last question is probably 70% of the class gets right, and some panic. It's a little bit of a tricky question. And there's actually, you could debate what this means. So I'm going to show you exactly what I mean so you to calculate it, but you could debate what this means because there's some other noise in this question. But what I want to get thinking about with insurance companies is a big part of their net income is estimates from actuaries. And those estimates are extremely material. I don't mean, the reserves they set up 5 years ago were off by 2% of net income or 10% net income. I mean, they were off by 70% of net income. They reported 500 million net income. They should have reported 950 million in net income. I mean, it's huge. Not because actuaries aren't good, they're very good at what they're doing, but these are really tough forecasts to make, and they really are forecasts. That's what these things are. So What I'm asking is how much was their 2021 net income misstated for the 2008 business and in which direction? So a couple of things to be careful here with. First of all, we're talking about net income, but we're looking at claims. So if they overstate claims, they've understated net income, right? If they understate claims, they've overstated net income. All right. So let's look at, it says the most recent information available. That's what they thought as of 12/31/23. So as of 12/31/2023, their incurred was 2018. I stuck with 2008 the whole time. 18,500,159. We've seen that number before. That was 12/31/2021 incurred was, these are estimates, right? Part 3 is not an estimate. How much they actually paid, that they know. So as of 2021, they thought 2018 was going to be, and we've had this one as well, 18,235,859. I've written that number down a couple of times here. All right. So their claims were overstated or understated in 2021. Well, they thought in 2021 they're going to be 18 billion 2. They should have been 18 billion 5. Understated. I think we already did that number, right? 264, 291. Is that the same number we just did up here? So if they had known in 2021 what the actuaries knew in 2023, they would have set up an additional 264, 291 in claims, and our net income would have been lower. Whatever you say here, you say the opposite for net income. Net income was overstated by 264. We'll get a little more practice with this. But if you go back to the 2021 net income, it might have been $600 million, $400 million, but it would have been 264, 291 lower if they had known. That's how material actuaries are to these businesses. Everybody agree with these numbers, or do I have a typo anywhere? Kind of made it easy for you by using the same numbers we used in part 2 there. You may not need as much highlighters. I keep that consistent. So 4 can be a little tricky. Some students get the right number, but get the overstated and understated backwards. So I'll give quite a bit of partial credit for that. It's a strange question, but I want, when you're thinking about this business, just realize their net income is really not their net income. It's an estimate, and it's materially off, and we know it's materially off, but we only learn that over time as we get more claims. Has nothing to do with the professionalism of the actuaries. It has to do with the difficulty forecasting the future.
Those are like rounded numbers. Would we say, do we have to say, like in our final answers, make sure that that's 264 million?
Well, I wouldn't round 2, 3, and 4. I would only round number 1.
What sense it's in millions instead of millions?
Yeah, I mean, if you do, I wouldn't count off for it, but I mean, if I do have students, I haven't had well, did your calculator not large enough for that number?
For the first number, I think was 1.
Was that a larger number? It goes 3 more decimal places, right? So it doesn't have so this one you can round and I don't mind you rounding just because you're doing a ratio, so you're gonna get pretty close. But I wouldn't round these numbers. I mean, it makes it easier for me to grade if you don't round, because then everybody has the same answer. But if you round it up, it wouldn't be a big deal. All right. We'll get a little more practice with Schedule P as we go. All right, I will save this out there now. I do have another page. I'm going to save this out there. The first question will work. I don't know if we'll get to it on Monday or not. We could start it tonight. Let me see where we are in the notes. Yeah, I usually do it in investing. So this last question we won't get to for a little bit. So I won't hand it out. You don't have the handout of it yet, so you're like looking for it. Where is it? You don't have it, but it will, when I save it, will be out there. Maybe what I'll do is I'll put this at the very bottom, so it's not so confusing. Those are the 3 questions on the final, so you know that for sure, not those specific ones, but those with different numbers. So you now know the math part of it, so you just have to figure out the essay part. The essay part, I can't remember. Oh, the big essay question is the credit score question. And hopefully you have good notes on that one that you can put together. Let me real quickly go through this because it's a minor issue. It won't take us that long to get through it. So when you think about insurance, you think about it as an individual person buying insurance, personal lines insurance. We covered on exam 1 about corporations buying insurance, that they're a little bit different, and they are quite a bit different. There's a lot of insurance that's purchased by corporations that really doesn't transfer risk. It's really done for other reasons. And so what this shows is that a continuum between insurance that mainly transfers risk and insurance that is mostly retention. Most of us buy guaranteed cost insurance. That's your auto insurance or homeowners insurance. That's what individuals buy. The insurer agrees to reimburse you if you pay the premium. The premium's fixed at the time the contract's signed. They can change the premium, but they can't change the premium based just on you. They have to change it based on the class they put you into. So they can't say, well, we really don't like you. We're going to charge you more. We just, your phone number irritates us, whatever it is, you call us too much. All they can do is charge you. Now, if you've had a lot of accidents, they can charge you more, but that's because you went into a new class of insurance. So that's guaranteed costs. They can raise the premium only based not on your experience, but based on the experience of your group. All right. So if they don't have a large enough group, guaranteed insurance like this doesn't work. But auto insurance, homeowners insurance, they're going to put you into a group and your premium's going to be based on that. Your group can change. You don't have the reinstatement thing that we heard with the reinsurance, where you have to pay a big premium to keep the insurance in force if an accident. That's kind of irritating, right? So, okay, well, you had a car accident, so we're going to have to charge you an extra $1,000 if you really want insurance. So you don't have that. You just keep paying the premium, and until the contract's over, you're insured. Experience rated is when they are going to look at some of your experience, and that will influence your premium. There's something called credibility, and that's how much of your personal experience will go into the pricing. So essentially for auto and homeowners insurance, it's experience rated insurance plans where your credibility is 0. They don't give you any credit for your actual driving. Whereas an experience rated plan, they may say, okay, well, the premium's 90% based on the group you're in and 10% based on your own experience. Workers' comp is a lot like that. Say, wow, you've had a lot of workers get injured. We're going to charge you an extra amount, or your workers are really, really safe. They haven't had any accidents. We're going to charge you less, but it won't be your entire premium. It'll only be a portion of it. The higher the credibility, the more you're self-insuring, because they're just going to charge your premium based on your experience. So, essentially you're insuring yourself. Retrospective rated plans are somewhat similar. It's just that, it sounds almost like you're not getting any insurance at all. but you don't actually know your premium until the end of the policy year, and then they go back and retroactively change your premium based on your experience. That sounds like you're insuring yourself, right? They say, wow, you had $5,000 in accidents, we're going to raise your premium $5,000. That sounds unfair. But there is a range that they can charge you. Over that range, they have to stop. So they have to say, all right, your premium can go higher or lower by $2,000. So if you have a $1,500 accident, they can charge you $1,500 and you essentially insured yourself. But if you have a $20,000 accident, they can only charge you the extra $2,000. So within the range, you're essentially insuring yourself. Outside the range, you've got that protection. Some plans are really administrative, where you're essentially insuring yourself, but they're doing all the admin, and it looks like insurance because you're paying a premium, but you're really paying them to do this. But you do get something called a stop loss. And what the stop loss says, part of your premium says, an extreme, really large loss, then you're covered. But most of the time you're not covered. You're insuring yourself, all right? And you're just buying it to help get some of the workload off. You don't have to hire the workers. And then mostly retention, captive insurers. Kirby didn't talk about that. I should have asked him about the captive. USA had a captive for terrorism risk. A captive is, it sounds a lot like cat bond. Oh, I got to tell you all about cat bonds, but it's kind of like cat bonds where, you know, USA sets up this trust, and that trust becomes a reinsurance company, and USA is the only customer. A captive is a lot like this, where you create an insurance company, it's a subsidiary, and you're its only customer. Doesn't sound like you're insuring yourself, does it? I mean, could you set up your own auto insurance company? You put 20,000 in it to start the company, and then if you have claims, you have to pay yourself from your company. Why would you do this? When companies do stupid things, what's the reason usually? Tax law. They get special tax treatment doing that. We talked about that a little bit earlier on exam 1. There are tax benefits to corporations of having insurance, and if you can set up your own insurance company and get that tax benefit, that's a cool way to do it. That's a captive. Captives are actually quite popular, and almost all of them are in Bermuda or Cayman Islands or whatever. Like Kirby was talking about, they can't step foot on U.S. soil because you're trying to avoid taxes, so you better not be on the soil. And then a finite risk plan is essentially we're not going to insure you, but if something happens, we'll agree to loan you money. You got to pay us back. Doesn't sound like, you know, if you say, hey, if you're an auto accident, we'll loan you money to buy a car. It doesn't sound like insurance because you got to pay them back. But ultimately, everything is risk transfer, because if you go out of business, your bondholders take it all, right? You transfer the risk ultimately. So corporations are more in these lower levels than they are in this upper level. They tend to do more self-insurance and for other reasons. So you're kind of in this, you may see some of your companies may do things, and even a non-insurance company could do a captive just to help protect your risk. All right, just one last thing. I'm gonna let you out early, but on the cat bonds, I have a meeting. Who's a cat bond? Daniel and Beverly and Don. Okay, so I'm meeting Thursday at 2:00. Y'all are welcome to sit in if any of y'all want to. It's an introductory call. I'm going to try to use it to set up a meeting with your team. So we found it's really interesting. Victory Capital just purchased another company, and that other company just started a catastrophe ETF. So we're going to talk, and those people are like, oh yeah, we talk to college students all the time. So, well, hopefully if any of y'all want to sit in on Thursday, you can, or I'll take notes and we'll set up another meeting for y'all so that y'all can get into the details. What I'm going to tell them is we got the insurance company side from Kirby, and you can research that. Now we want to hear the investor side. Why do investors like catastrophe bonds, and how do they view them and their understanding of them? So it should be a really good, I'm glad we made this contact. So, all right, I'll let y'all early.